After posting the best start to a year since 1997, the S&P 500 declined for the first time in 4 quarters during the third quarter. The index's winning streak continued into July, pushing the market near its all-time high set on January 2nd, 2022. However, in August, a steady stream of news drained enthusiasm from the equity markets, snapping a 5-month growth streak at a time of the year known for cooler market performance. Among that news, a tick in the wrong direction of a key measurement ignited fears of a second wave of inflation. Oil prices rose, as did bond yields. Chairman Jerome Powell reiterated the Fed's commitment to lowering inflation with higher interest rates. Fitch Ratings downgraded the U.S. sovereign credit rating 1 notch from AAA to AA+. And cracks in China's economy highlighted structural challenges in the world's second largest economy. In September, potential government shutdown, softer consumer confidence, a slowdown in home sales and home starts, higher oil prices, persistent inflation, and the Fed's message that the funds rate will be higher for longer all combined to bring the S&P 500 down 4.87% for the month. Ironically, September is traditionally known as the weakest month of the year. Before looking at broader market performance, I would highlight that recent volatility is not anything out of the ordinary. The S&P 500 posted only its second pullback of 5% or more in 2023. Historically speaking, these market declines happen 3 times per year. Market performance for the quarter was challenging across all segments. Smaller companies posted their worst performance since the second quarter of 2022 and lagged their larger brethren for the 9th time out of the last 10 quarters. On this chart, I would also highlight the year-to-date performance of the NASDAQ because I believe it paints a rosier picture for the S&P 500 versus reality. Despite the gain for the index over the first 3 quarters of 2023, performance has been dominated by the tech heavyweights, and the average stock is up only 0.3% year to date. In fact, the contribution from the 10 tech heavyweights have accounted for 100% of the year-to-date performance for the S&P 500. I believe in order to see a meaningfully higher move for equities, we need to see additional broadening in breadth as the current one-dimensional market has been a challenge for well-diversified, actively managed portfolios. Turning to fixed income, things were equally challenging during the quarter as the Bloomberg U.S. Aggregate Bond Index declined 3.23%, the second consecutive quarter of negative return. Bonds were pressured as longer duration yields rose intra-quarter to multi-year highs amid concerns over resilient economic data, fears that the Fed will remain higher for longer, and that rising oil prices would challenge the downward trajectory for inflation. The index has also declined 4 straight months, tying the second longest streak of consecutive losses since 1994. The past 2 years have been extremely challenging for fixed income investors. Coming off its worst year since 1975, the index is once again in negative territory. This chart that details 3 and 5 year rolling returns depicts that. With that said, I'll reiterate my comment for the fourth quarter of 2022 commentary that bonds are back. Yields are significantly higher across all segments of the market. As savers, we should applaud this higher income. Many of you have positively experienced this as your cash savings is now paying you a return. Fixed income pundits are closely watching the Federal Reserve. The FOMC delivered its 11th interest rate hike in July, extending the most aggressive hiking cycle over the last 40 years. The target range is now between 5.25% and 5.5%, the highest Fed funds rate in 22 years. At September's FOMC meeting, the Fed elected to hold rates steady for the second time this cycle. However, markets were surprised by the updated summary of economic projections where the Fed hinted at one more rate hike by year's end and projected 2 fewer cuts in 2024. The Fed's steadfast language has elevated Treasury yields. The 10-year Treasury yield hit a 15-year high after the Fed suggested it would keep interest rates higher for longer than investors have expected. Compared to August, rates for notes beyond 7 years were up roughly 50 basis points, while 2-year rates were up 20 basis points, and 5-year rates increased 34 basis points. As a reminder, 100 basis points is equal to 1%. The higher for longer interest rates are expected to weigh on the economy, but also have created opportunities to lock in these elevated yields. One bright spot within fixed income was high yield bonds, which rallied for the third consecutive month and eked out a slightly positive return for the quarter. The return is somewhat of an anomaly during a risk-off environment, meaning that stocks declined, and one during which interest rates rose. The return for high yield is attributed to its shorter duration and elevated exposure to the energy sector. Please contact me if you have any questions. Thank you for your trust in us.